channel. Today we are going to cover net present value. We'll use the December 2014 F9 ACCA question. Let's go to the requirements. Required, prepare a revised draft evaluation of the investment proposal and comment on its financial acceptability. 11 marks. B. Explain any 2 revisions we have made to the draft evaluation in Part A above for 4 marks, total 15 marks. Let's go to the scenario. Question 4. UCO is a large company which is listed on a major stock market. The company has been evaluating an investment proposal to manufacture product K3J. The initial investment of 1.8 million will be payable at the start of the first year of operation. The following draft evaluation has been prepared by a junior employee. We are told that the following information is prepared by a junior employee. What does that mean? This means that this information is not correct because the employee is still junior. We've got the years 1, 2, 3, 4, sales units per year, selling price dollars per unit, variable cost dollars per unit. Note the above selling prices and variable cost per unit have not been inflated. Therefore, we need to inflate those. They will be given the inflation rate. Below that, there is a calculation of the net present value by this junior employee. Then let's go to the notes. The junior employee also provided the following information. 1. Relevant fixed costs are forecast to be 150,000 per year. 2. Sales and production volumes are the same and no fixed goods inventory is held. The corporate tax rate is 22% per year and the tax liabilities are payable 1 year in arrears. UCO can claim tax allowable depreciation of 25% per year on a reducing balance on the initial investment. A balancing charge or allowance can be claimed at the end of the 4th year. It is expected that selling price inflation will be 4.2% per year, variable cost inflation will be 5% per year, and the fixed cost inflation will be 3% per year. The investment has no scrap value. The investment will be partly financed by a 1.5 million loan at 10% per year. UCO has a weighted average cost of capital of 12% per year. Required, prepare a revised draft evaluation of the investment proposal and comment on its financial acceptability. That's number 1. Now, we have to calculate the net present value. To calculate the net present value, we should have the discount rate, which we are given here as 12. We should also have the number of years on which the program will run, the project will run, which is 4 years, and the initial investment, which is 1.8 million, and the cash flows. Now, let's do our calculation. Uftin core NPV calculation. We start with workings. The first working should be sales. We are told here on note 2 that sales and production volumes are the same and no goods inventory is held. And we are also told in note number 6 that it is expected that selling price inflation will be 4.2% per year. percent per year. Then now let's do our years. Year 1, year 2, year 3, year 4. Then we've got the units sold. Let's work everything in thousands. Units sold is 95 for year 1, 100 for year 2, 150 for year 3, 150 for year 4. We've got the selling price. The selling price is 25 for year 1, 25 for year 2, 26 for year 3, 27 for year 4. These selling prices are not inflated as we were told. Then we calculate the inflated price. To inflate the price, we'll say one plus the percentage of inflation to the power 1 for the first year. We multiply that by the selling price. We get 26.02. Then we can copy the formula to the last year. So if we can check our last year, it's 1 plus the percentage of sales multiplied by to the power 4, which is G6, multiplied by the selling price that is not inflated. We get the inflated selling prices. Then our sales revenue will be the inflated price multiplied by the units. Then we copy the formula up to the 4th year. Let's remove the commas. Then we have our sales. Then let's underline that. Now we've completed our working number 1 for sales. Now we go to working number 2, which is variable costs. We are given on note number 6 that the variable cost inflation will be 5%. Now let's copy like that. Then to save time, let's copy that. Then here we'll say variable cost, inflated price, total variable costs. The units remain the same. The variable costs 11 for year 1, as we can see here, 12 for year 2, 12 for year 3, 13 for year 4. Then we come and put our formula here. we come and put our inflated variable cost, which will say 1 plus the inflation rate. We log that cell for inflation rate to the power 1 for year 1 multiplied by the variable cost that is not inflated. Then from there, we can drag the formula to the last year. Then let's put commas here. There we go. Then let's check our formula for the total variable cost. It's saying inflated price multiplied by the number of units. Same, let's check for year 4. Inflated price multiplied by the number of units. Therefore, we have completed our working number 2. Let's go to working number 3, which is fixed costs. Inflation for fixed costs, we are also told in note number 3, 6, that is 3%. Then we copy the years. Then we copy the fixed costs per year. Fixed costs per year. We are given in note number 1 that the relevant fixed costs are forecast to be 150 per year. So we've got 150 in year 1, 150 in year 2, 150 in year 3, 150 in year 4. Then we need to inflate the fixed costs. Inflated costs. In year 1, we will say 1 plus the inflation rate. We log that cell to the power 1 for the first year. Then from there, we multiply by the fixed cost for that year. Then we can drag the formula there. Let's put commas there. There we go. We have our fixed costs. The fourth working is tax saving on capital allowances. Let's copy the years. Therefore, the fourth working, we say it is tax saving on capital allowances. Now, we have to, let's go where we are given the note number 3, the corporation tax rate is 22% per year and the tax liabilities are payable 1 year in arrears. UCO can claim tax allowable depreciation on 25% per year on a reducing balance on the initial investment. The initial investment is 1.8 million. Then Note number 5 saying a balancing charge or allowance can be claimed at the end of the 4th year. Now, let's get the cost of the investment. The cost of the investment is 1,800. Then in year 1, we are to depreciate this cost by 25%. We get 450. The second year, the depreciation will be 75% less than the depreciation for the first year. Third year, and fourth year, then the fourth year, we have to have a balancing allowance. So we'll say cost minus first year's depreciation minus second year's depreciation minus third year's depreciation. So the fourth year's depreciation will be the balancing figure. Please take note of this. Depreciation for year 1 plus depreciation for year 2 plus depreciation for year 3 plus depreciation for year 4 should also equals to the cost of the asset, because there is no residual value. So if we add the depreciation for year 1 up to year 4, it should come to 1,800 in thousands. Then now we calculate the tax at 22%. We say 450 multiplied by 22%. We get 99. For year 1, we copy those figures. Then we get 74 for year 2, 56 for year 3, 167 for year 4. These are the tax savings that we have. Now, we have got everything that we need. Then we go to the NPV calculation. We have got the years, we copy that, year 1, 2, 3, 4. Then we've got the sales. Sales for year 1 is 2475. We copy that. We can also copy the formula up to year 4. Then we've got variable costs. We've got variable costs from working number 2. We can, if we copy for year 1, we can copy up to year 4. Then we have got fixed costs. Fixed costs from working number 3. We copy the year 1. Then we drag the formula up to year 4. From here, the figure that we get here is our profit. Some they say cash profit. The figure that we get here is our profit. It's sales minus variable costs minus fixed costs. We get the answer for year 1. We drag the formula up to year 4. From here, we calculate tax payable. Tax at 22%. Let's go to note number 4. The corporation tax rate is 22% per year, and tax liabilities are payable 1 year in arrears. So the tax for year 1 is payable in year 2. So we'll say profit for year 1 multiplied by profit in year 1 multiplied by 22%. Then we copy the formula to if we can see here, we now need to have year 5 only for tax purposes. Then from here we add tax saving from working number 4. Year 1 tax saving will go to year 2. Then from there we copy the formula there. Then from here we have our cash flow. Our cash flow will say the sum of our profit less any tax. So for year 1, that will be that. We copy the formula up to year 4. Then we discount at 12%. Discount rate for year 1, it should be 1 divided by bracket 1 plus 12% to the power 1 for the first year. We get that. Then we can drag the formula there. Then we get our discount rates. Then we get when we multiply, we'll get our present values. Then we'll say cash flow multiplied by the discount rate. Then we drag the formula to year 5. Then our net present value will be we'll say the sum of the present values. Here we'll say the sum. We sum from year 1 up to year 5. Then we say investment, which is 1,800. Then our NPV, which is the sum of these. We get the NPV of 2509. That's our NPV. Also, there is a shorter way of calculating NPV because our assessment is now computer based. So we'll say NPV. Then the NPV, we'll put the rate first, which is 12%, comma. Then we put the values that were not before discounting them. We close the bracket. We subtract the initial investment. Therefore, we get the same NPV. That one is the shortcut. You need to practice it. So here our NPV is 2509, which is positive. Therefore, we accept the project. The project is worthwhile. Now let's go to question B. Question B is saying, explain any 2 revisions you have made to the draft evaluation in Part A above for 4 marks. Now, this is our NPV calculation that we have done. So now we have to compare our NPV with the NPV calculation of the junior employee. Now, if we can see, sales revenue, the junior employee for year 1 had 2475, but for year 2, the junior employee had got 2605, whereas we have got 2714. What does this mean? The junior employee did not inflate year 2 sales by saying to the power 2. The junior employee only affected to the power 1 in all the cells. Let's go and I will show you that year 1 our sales were 2475. For year 2, if we put 1 here, we'll get the same figure as the junior employee. If we also say 1 in year 3, we get the same figure as the junior employee. And also if we say 1 for year 4, we get the same figure as the junior employee. But this is wrong. In year 2, we have to inflate by 2 years. In year 3, inflate by 3 years. In year 4, inflate by 4 years. Also, the variable cost, the junior employee did the same thing. If we put 1 here, we'll get 1260 like the junior employee. If we put 1 here, we get 1890 like the junior employee. If we put 1 here, we get 2048 like the junior employee. So the junior employee did not compound the inflation, of which is wrong. Again, also in fixed cost, you use the inflation for 1 year. If we put 1 here, we'll get 155. If we put 1 for everywhere, we'll get 155, of which is wrong. You have to compound the inflation. That was the error number 1. The error number 2, the junior employee included interest payments. Interest payments must not be included in the NPV calculation, as they are also included in the discount rate that is used, which is 12%, which is the weighted average cost of capital. So you mustn't include interest payments in the NPV calculation. Then also, the junior employee included tax allowable depreciation of 450 per year. This is not reducing balance method. This is straight line. The reducing balance method, the first year will be 450, second year 338, third year 253, then fourth year, which is 759, the balancing allowance, not the straight line of 450. And also, if you subtract the tax allowable depreciation, you should add them after you have calculated the tax payable, as the tax allowable depreciation is not a cash flow. Then those were the errors that were done by the junior employee, and if you were able to pick that up, you were also going to earn yourself 4 marks on Part B. Thank you very much, guys. Do not forget to subscribe to my channel. And also, this question and also this solution will be downloadable under this video on the comments section. Thank you very much. Share and comment on my channel.